You're an investor. You have a bunch of money. You want to leave it for your granddaughter 30 years from now. Your choices are gold or Bitcoin. I took 50 million of my own money. I bought it. I bought it when everybody said, you're foolish to own Apple. You should diversify into all the other computer companies. Bitcoin's like an open source project. There's no company behind it. It's an emergent phenomena in cyberspace. And as it emerged, the early days, it was very uncertain and scary and complicated. And so how will the IRS tax it? Will the government ban it? Will it be illegal to hold it? The early exchanges were failing. Mt. Gox failed. The early use cases were Silk Road. It could have been destroyed because it was banned. It could have been destroyed because it was hijacked by bad exchanges. It could have been destroyed because it was forked. Everybody said, well, either someone else is going to copy it or the government will ban it. Over the last 8 years, what happened is it was copied 6,500 times. It's the winner of the crypto war. So how do you get comfortable with it? Well, after it's been attacked 6,500 times by clones and they've all failed, when it emerged to be 95% of all of the proof of work networks, like 95% of all the monetary energy in the crypto asset space is on the Bitcoin network, then you know it's Facebook, it's not MySpace. So we had to watch it get to a point of maturity where it's seasoned. And we had to watch all of these bad exchanges failed, and all the bad actors failed. And we had to watch the development of a regulatory apparatus. So now you have KYC regulation on the exchanges in the US. You have clarity with regard to how it's taxed. You have clarity with regard to what it is and isn't. I think people are starting to understand it's not a currency. It's not a payment network. It's a bank in cyberspace that allows billions of people to store their money. It gives them a simple, straightforward, affordable, secure savings account for people that can't set up their own hedge fund and don't know and can't get into a hedge fund, and they just want to put their money in a bank. The politicians and the country has destroyed the savings account over the past 30 years. When I was a kid, you put your money in a savings account, get 5% interest, and everybody believed that the money was going to be more valuable in the future. You wouldn't lose your money. And that option's been deprived. Bitcoin has emerged from casino, gambling, scary, to the savings account or savings and loan at the end of the universe. And that's the journey of the 10 years. And that's why I could get excited about it in the year 2020. They tried 6,500 times over a decade. Everybody and their brother thought, man, could I copy this? And the problem is Bitcoin's the only one with the immaculate conception that's truly decentralized. It's the money. It's the crypto asset of the people. There's not an example of a digital network that hit $100 billion in market cap that was vanquished. Lots of billion-dollar things failed. Lots of $2 billion things failed. But once you get to $100 billion, I think the market has spoken. If the bank doesn't fail, and 95% of the cities in the world, the banks failed in them over 100 years, but the countries and the regimes failed too. So you're trusting in a country or a company. On the other hand, if you actually buy Bitcoin, you have the option, not the obligation, but you have the option to take custody of those keys. And that's advantageous for you in two reasons. One, you can switch custodians quickly. In half an hour, you can move your money from one bank to another bank, one country to another country. That keeps everybody honest. And it's useful in a capitalist world if you have options and no one's holding you over a barrel. And the second is, I can hold a gun to your head, pull the trigger, kill you, and take your gold. But if I hold a gun to your head and pull the trigger, I can't get your Bitcoin. I can just kill you. And there's a very important subtlety there, which is at the end of the day, you control your life force. It shifts the balance of power back to the individual versus the bank, the custodian, the country, anybody that would coerce you and steal your life force from you. And in that way, it's a libertarian idea, but it's also a capitalistic idea. And it's also just a matter of decency to the individual. The number one problem every investor in the world is facing right now, and there's $250 trillion or more worth of this problem, is I have monetary energy. Where's my store of value? How am I going to conserve my monetary energy in the current macroeconomic climate? As long as the central banks are expanding the broad money supply, M2 expanded by 5.5% a year for 10 years, this year it expanded by 24%. If the monetary supply expands by 10 to 15% a year for the next 3 to 4 years, the banks are sucking the oxygen out of the room. They're sucking 10 to 15% of the purchasing power from all of your investments. And the question is, if I'm holding cash and I have 500 million in cash and I'm looking at losing 15% of the purchasing power every year for 5 years, the risk was I'm going to lose 75% if I do nothing. It made it easy for me to take another decision because I expected that doing nothing with money, with cash, is losing half to 75% of your purchasing power. It's not a problem if the money supply is not expanding. The expansion of the monetary supply is like I'm sucking 5% of the oxygen out of your room every year or every month. How long will it be before you leave? What do I do with that? Well, I got to find a store of value. A bond is only a store of value if the coupon is higher than the rate of monetary expansion, unless I have expectation that the interest rate will fall. A 5% bond can work as long as you keep cranking down the interest rates. But when interest rates get to zero, unless you go negative, bonds don't hold value. Everybody in the bond market has figured this out. Either interest rates go negative or you got to exit. Now, how about stocks? Stock can hold value if the cash flow per share grows faster than the rate of monetary expansion. Google, Amazon, Facebook, they work in the last decade because they're growing 20% and the money supply is expanding 5%. But if the money supply expands by 15%, how many equities are going to expand cash flow per share by 20%? By the way, how do you do that if you're not? You have to leverage up, right? So if I'm growing 5% a year cash flows, I have to borrow money, I go short the dollar, I borrow billions, I buy my stock back, my cash flow per share goes above the hurdle rate, and I can hold value.